Net income is basically earnings before taxes times 1 minus tax rate. And earnings before taxes is incremental sales minus incremental costs minus depreciation. I said incremental on purpose because if there are side effects, it's not those sales that I'm interested in. It's change in sales. Again, change in costs. When I say change, compare sales with the project minus sales without the project. That's why I said incremental, not change. Change typically is associated with from one period to another. And NCS is calculated using cost of plant, property, equipment, including any opportunity costs, and salvage values are thought of as negative capital expenditures. And any assets acquired from the firm, such as using land firm already owns, are returned to the firm at the end of project life. So that would be also negative capital expense. I'm using a land that's worth $60 million in the market right now. In year zero, because it's an opportunity cost, I'm going to view that as $60 million worth of capital expenditures. 10 years from now, I think that land is going to be 70 million. When the project is done, I'm going to return all of that back to the firm. So I'm going to be basically selling it back to the firm at the market value. So that's going to be, in a sense, cash inflow or negative capital expense. Change in net working capital, such as inventory, accounts receivable, accounts payable. That is caused by acceptance of the project, are considered short-term capital expenditures. And they also are returned back to the firm at the end of project life. I come up with a new product. Obviously, that product needs to be sold. As a result of any sales process, you have to keep inventory. and B, some of those sales are going to be made using trade credit. Well, all of that needs to be financed. Firm has to come up with the money to finance that. Hence their short-term capital expenditures. Technically speaking, net capital spending and change in net working capital, they are similar in nature, but net capital spending is on fixed assets and change in net working capital is on current assets, if you think about it. Now I have only 20 minutes left. Let's talk about different methods of depreciation and how they affect salvage value and net income for pro forma income statements. And there are many different ways to depreciate. You have straight line depreciation. Depreciate the acquisition cost. Equally over the tax life of the asset. Not all assets have the same tax life. A computer, for example, has a 3-year tax life. On the other hand, heavy machinery, probably 15, 20. And IRS determines what they are, and I have no idea. You just look them up. Certain assets are subject to actually depletion. For example, natural resources. If the asset is an oil well and there is a proven reserve of, let's say, 100,000 barrels, and you're gonna extract that over 10 years, every year you're gonna write off 1/10 of that. Okay. Are depreciated using useful life and how much it is used. Say example here, oil wells. And typically examples of these are transportation equipment, suppose a truck has a useful life of 100,000 miles. If you drove that for 25,000 miles this year, you get to depreciate 25% for that year. Next year, you draw only 10,000, then you get to depreciate only 10% until you reach zero. But most common depreciation method is modified accelerated cost recovery system, short makers. IRS provides you with a table for each tax life, and these are 3 years, 5, 7, 10, and 20, I believe. I already have those numbers somewhere around here because I covered stuff like that in my basic finance. Let me see. Okay. I'm just gonna get rid of all of these. These are the percentages for 3 years. It's a 3-year makers table, but technically you write off everything in 4 years. And the first year is always equal to what you would have done, almost always equal to what you would have done under straight line depreciation. Okay. If it is a subject to 5-year makers, the first year you write off 20%. But under straight line, second year you would have written off 20 as well. But under makers, you write off 32. So the first 3 years, you're going to write off 71%. Under straight line, you would have written off 60%. So this is a faster write-off. So the tax benefit is achieved much faster. So on present value terms, this is actually better for the firm. And the firms can actually choose which depreciation method they can use. Now we have those tables. Now let's build a table of book value every year based on those. Cost of plant, property, and equipment, let's say $10 million. Even though I already have it, I want to show you guys some neat little Excel skills. I mean, I didn't do that for my basic finance class, but for this class, I'm going to. Tax life. Let's say 10,